The stock market has moved from signs of excess to signs that a correction is beginning. How might this correction unfold? Hey, this is Arthur Hill, Chief Technical Strategist here at TrendInvestorPro.com. And today we're going to start off with a weekly chart because the market has been paralleling what happened in January 2018. I'll show you the signs that we had of excess. We had outsized candlesticks. We had a PPO that was extended, and now we're getting signs that a correction has unfolded. And we'll look at how that correction unfolded in 2018, and then we'll look at a couple of corrections in 2019 to get an idea of what we might expect in the coming weeks. So we're going to go back exactly 2 years ago to January 2018. And what I want to show you is how the advance progressed from a normal advance to showing signs of excess as it went pretty much parabolic in January 2018. So if we look at this chart here, first there's the normal advance from August up until December. You can see there aren't any big outsized gains. The PPO, which is down here, shows the distance from the close to the 40-week EMA here. And you can see it was around that 4, 5, 6% area in September and then moved above 6 in October. And you can see the weekly rate of change didn't get above 2% during this entire advance. So it was relatively stable, if you will, or steady. But things clearly changed as we got into January. And there you can see we had three big weeks basically. This was a smaller week in between, but those are three outsized candlesticks. They're the biggest candlesticks of the entire advance. And when you get a big candlestick or a number of big candlesticks after a big advance, that's a warning sign. All right, if you get those after a big decline, that's a sign of a reversal. But after an extended advance, that becomes a warning sign. So we got basically three outsized candlesticks, and you can see that in 2 of those weeks, the gain was above 2%. So basically we had the biggest gains of the advance happening here. And then the PPO, so basically we have outsized candlesticks, we have outsized gains, and then we have the PPO moving above 10% for 3 weeks. That means the S&P 500 SPDR here, SPY, or the S&P 500, take your pick, was more than 10% above its 40-week moving average, exponential moving average here. And that was a sign of excess. So how does this compare to January 2020? Let's take a look. So here we are in the present, and we can see this October low here, and we've got a pretty steady advance going here. So everything is looking okay here. We're just continuing higher in a steady, normal fashion. And you can see the PPO is not above 10%, and the 1-week rate of change does not exceed 2%. But then we get into the middle of January, and the PPO gets to 9.74%. Now that's not above 10%, but it is close enough. It is signaling excess. And then if you look at these 2 candlesticks, the 2 bodies are the biggest bodies of the entire advance. And the candlestick body means the open and the close. So you had an open down here and a close above here. So you open pretty much on the low, close near the high. You had a big week from open to close. And these were the biggest weeks of the entire advance. And so after an advance, an extended advance, when you get these outsized candlesticks, that's a sign of excess, and that can be dangerous. In contrast, if you look at this candlestick or these candlesticks here, they're coming off of a low. So these are outsized candlesticks off of a low. Here's another one. That is bullish. But if you have outsized candlesticks after a high, that's a warning sign. It's not actually bearish because you can become overbought and remain overbought. So we get the 2 outsized candlesticks, we get the PPO almost at 10%, and then the rate of change hit 1.92% for that week. So we didn't get above 2%, we didn't get above 10% on the PPO. It wasn't an exact excess signal, but come on, the market is not an exact science here. But you look at this chart and you can see we're clearly moving into signs of excess, or we did in mid-January. So let's go back now and see what happened in January, February, March 2018. Now in these next two charts, we're going to look at three different corrective periods. We've got one here in 2018, and I've got two coming up for 2019. And corrections, as Forrest Gump would say, are like a box of chocolates. You never know what you're going to get. They can come in different shapes and sizes. They can last, they can be short in duration. They can be short pullbacks. They can be long pullbacks. They can be long in duration. So you never know exactly what you're going to get. But if we look here at January 2018, there you can see this big downsized move, and that signaled the start of the correction. And man, it happened fast. And if you look at the low of the correction, it happened in the second week. I mean, how crazy is that? But then it took another 13 weeks or so to stabilize. So you had this big symmetrical triangle, which is a sideways consolidation. And when you move sideways, that's kind of a correction in time. So you can correct in time and price, or usually a combination of both, where you had this move lower and then you bounce and then a move lower. And you can see we're hitting that 40-week SMA. And yes, I switched from EMA to SMA because I think when you're using the S&P 500 or SPY, you need to use the 200-day SMA and the 40-week SMA. And that's an area to watch for support. And as Katie Stockton said, the SMAs, moving averages, are not like exact support levels. They're kind of like cushions. And so you come into this cushion and you're finding support for a number of weeks. And so the symmetrical triangle is basically a bullish continuation pattern. So the bigger trend was still up during this consolidation. You can see the PPO 440 was positive, and that meant the 4-week EMA was above the 40-week EMA. And I typically use that 440 as kind of a long-term trend barometer. And you can see we're bouncing off the 40-week SMA, and then we get the ascending triangle breakout there. And then the market moved higher into September and October. So here we are with the current chart, and there you can see the signs of excess, as I pointed out earlier. And I want to show you two other corrections that we had in 2019. First, what we have is the kind of garden variety pullback. And, come on, this is a huge advance. You're entitled to a correction after that big advance. Again, you can see the outsized candlesticks off of this low. Those are bullish outsized candlesticks. And then we got the breakout here after this small correction back to the 40-week moving average and a new high. And then we had another correction. It was an ascending triangle. And that was 13 weeks of stall. But an ascending triangle is a bullish continuation pattern, and it was confirmed with the breakout there. So now we've gone up. We're like up 15% from early October to mid-January. And the market is clearly entitled to a corrective period after such an advance. It's perfectly normal. And we can see the 440 PPO is still positive. And as long as it remains positive, that's largely bullish. So how might a correction unfold? Well, as you can see here, I've labeled this the box of chocolates period, because we don't know what is going to unfold here. We just have a pretty good idea that the odds favor a corrective period going forward here. So you could have a pullback to the rising 40-week moving average, which will slowly continue to rise here. If the market pulls back, it'll flatten out a little bit. You have broken resistance turning into support here. So, it could be some sort of slow zigzag lower, and maybe this 302 area, 300, 305 area might be an area to expect support. But we kind of have to take it one day, 1 week at a time and watch price action as it unfolds. Because when that correction ends, it's going to be setting up for the next opportunity, and we want to be ready for that, like in October. Now, in addition to the signs of excess, I also want to point out that we kind of had a progression into defensive names over the past month or so. And we can see this in things like utilities. So utilities bottomed here in November and had this little surge. And then look at that breakout and that move, 8% pretty much over the last 2 or 3 weeks. That is a huge move. It's strong. And man, RSI moved above 90 for the first time ever. And this has been trading since 1999. Keep in mind, I'm looking at unadjusted XLU. I'm not including dividends in this. So you have money moving into this defensive name. And if we look further down, we can see REITs got into the picture here. We had the breakout in XLRE at the end of December with that bounce off the rising 200-day moving average. So REITs, again, another defensive area of the market. A stock alternative would be gold and gold miners. Gold miners are, of course, still stocks, but it is an alternative, so to speak. And you had that wedge breakout there at the end of December. Actually, the wedge breakout in early December and the resistance breakout right around Christmas, a smaller wedge and a breakout there. So that is looking positive too. And then if we look at gold, gold of course had the big move with the breakout right around Christmas, a little small wedge and another breakout. And these patterns were highlighted on trendinvestorpro.com. I follow these as part of my core group of ETFs. So they are monitored on a day-by-day, week-by-week basis. I don't publish every day, but I do publish weekly on this, on these ETFs in the core group. And then bonds. This is the newest one. We've got money moving into safe haven bonds. And there's the wedge breakout and the resistance breakout in the aggregate bond ETF there. And finally, one more TLT, the ultimate safe haven treasury bonds. Big move up, 26%, a one step backward correction in a wedge, and then look at that breakout. So in addition to the excesses in the market, we see money moving in defensive names, and we are looking like there's going to be a corrective period ahead. So even though I've outlined what a correction might look like, keep in mind that corrections are like a box of chocolates. You never know what you're going to get. And the best we can do is simply identify when this correction has started and then monitor prices on a day-by-day, week-by-week basis and look for signs that it is ending. And that's where the next opportunity awaits us. So check out trendinvestorpro.com. I will be following this correction as it unfolds and looking for the next opportunity for when it might end. We don't know when that will be, but I will be monitoring it on a day-by-day, week-by-week basis. You can subscribe and get immediate access to all the reports. So thanks very much for tuning in to this video and have a great day.